On June 12, 2026, SpaceX went public. Biggest IPO in history. $75 billion raised. Stock priced at $135, open trading, and by the next day the company was worth over $2 trillion. For context, that makes SpaceX worth more than Walmart, more than ExxonMobil, more than basically every company on Earth except a handful of names you already know. Elon Musk is now the CEO of two separate trillion-dollar public companies. SpaceX is also a company that has been around for nearly a quarter century, since 2002, which is far longer than the average company takes to go public. Microsoft did it in less than half the time. So this wasn't a young startup cashing out early. This was one of the oldest, most established private companies in the world finally deciding the timing was right. And the thing that made this IPO possible wasn't Starship. It wasn't Starlink. It was a merger 4 months earlier that most people didn't think much about at the time. SpaceX bought Musk's AI company, xAI, for $1.25 trillion in February 2026. And once you actually look at the numbers, that merger looks less like a strategic AI bet and a lot more like financial engineering. Let's start with what SpaceX actually is as a business, because the rocket stuff is honestly the smaller part of the story now. SpaceX makes money 3 ways. Launch services, where companies and governments pay SpaceX to put things in orbit. Government contracts, mostly NASA and the Department of Defense. And Starlink, the satellite internet service. Starlink is the one that matters most. It's reportedly responsible for somewhere around 58% of SpaceX's total revenue. In 2025, SpaceX pulled in roughly $18.5 billion in revenue. Most of that from Starlink subscriptions, which now sits at over 10 million subscribers across 100 countries. The launch business, meanwhile, only grew about 8% year-over-year, mostly from Pentagon and NASA contracts, because most of the actual rocket launches SpaceX runs are for their own Starlink satellites, not outside customers. So heading into 2026, SpaceX is a profitable satellite internet company that also happens to launch rockets. That's genuinely a strong business. Real revenue, real subscribers, real infrastructure that took 2 decades to build and that nobody else on Earth can currently replicate. Then there's xAI. Musk founded it in 2023 to compete with OpenAI and Anthropic in the AI race. Its product is Grok, the chatbot integrated into X, and the financial picture here is almost the exact opposite of SpaceX. saas standalone AI revenue was somewhere around $500 million. Its cash burn was estimated above $12 billion annualized. For context, that means xAI was spending roughly 24 times what it was making. Grok also trails OpenAI and Anthropic significantly on actual model performance and usage, and multiple co-founders have already left the company. This is the part of the story that matters. xAI was not a company that was going to be IPO ready on its own anytime soon. Not with those numbers. Not with that burn rate. Not with a product that was losing the AI race it was built to win. So in February 2026, Musk announced that SpaceX was acquiring xAI. He called it building the most ambitious, vertically integrated innovation engine on and off Earth. The stated reason was orbital data centers. The idea being that AI compute needs an enormous amount of energy and cooling. Terrestrial data centers are hitting real limits on power, water, and land, and if you could put data centers in orbit and power them with solar panels in space, you could scale AI compute in a way no one on the ground can match. That's a genuinely interesting long-term technical vision. Musk has said publicly that within 2 to 3 years, the lowest cost way to generate AI compute will be in orbit. The math he's pitching is that 1 million tons of satellites a year, each delivering significant compute per ton, equals 100 gigawatts of new capacity annually, with close to zero ongoing cost for power or cooling once it's up there, because you're running on solar with the vacuum of space as your cooling system. SpaceX has already filed with the FCC for up to 1 million satellites dedicated to this. It's an ambitious idea and it leans directly into the thing SpaceX is actually good at, which is launching huge amounts of mass into orbit cheaply. It's also, conveniently, a vision that takes years to prove out, which means nobody can call it wrong anytime soon. But look at what the merger actually did on paper, separate from whether the orbital vision eventually pans out. It combined a company making $8 billion in profit with a company losing nearly $5 billion a year. And it put both of those numbers on one balance sheet, under one ticker, going public at the same time. Here's why that matters for an IPO specifically. When investors buy into a public offering, they're looking at the S1, the prospectus, the disclosed financials. If XAI had tried to go public on its own, investors would have seen a company burning $12 billion a year with $500 million in revenue and a product that's behind its two biggest competitors. That's a brutal pitch. But fold XAI into SpaceX, and suddenly the AI losses get buried inside a much larger, profitable business. The headline number investors see is SpaceX's overall revenue, around $18.7 billion, and a path to $1 trillion by 2030 according to Musk's own projection. The AI segment's $5 billion loss becomes a footnote in a much bigger story about rockets and satellites and Mars. This is a financial structuring move as much as it's a technology bet. You take your unprofitable, struggling business and you merge it into your profitable, proven business right before the moment everyone is going to be looking at your books most closely. And the merger did something else that's worth paying attention to. It gave XAI access to a customer it desperately needed. After the merger, SaaS massive data center, called Colossus One, had a lot of unused capacity. XAI had built out over 300 megawatts of compute, more than 220,000 NVIDIA GPUs, expecting Grok's usage to grow into it. It didn't. Reports suggest the company was only using around 11% of its available chip capacity. That's an enormous, expensive, idle asset sitting on the balance sheet right before an IPO, which is exactly the kind of thing that forces a company to write down billions in losses. So what did SpaceX do? They turned around and leased the entire capacity of that data center to Anthropic for $1.25 billion a month. A direct competitor to SaaS' own Grok. Musk had publicly called Anthropic misanthropic just months earlier after they announced a major valuation round. Then he leased them his spare compute anyway. Google signed a separate deal for $920 million a month. Combined, that's something like $26 billion a year in locked-in revenue from two AI companies who are not related to SpaceX's core business at all, recognized right before the IPO priced. One analyst put it pretty directly: by leasing that idle capacity to Anthropic, Musk turned an expensive, embarrassing unused asset into a high-margin revenue stream just in time for the S1 filing. That's not really an AI strategy. That's balance sheet cleanup with extremely good timing. Now let's talk about how the IPO itself was structured, because this part is just as interesting. SpaceX filed confidentially with the SEC back in April, which let them get their paperwork reviewed by regulators without the public seeing the numbers yet. They targeted a valuation that started around $1.75 trillion and climbed to over $2 trillion as demand built. They did a 5-for-1 stock split right before the offering, which doesn't change anything about the actual value of the company but makes the per share price feel a lot more accessible to retail investors who might balk at buying a single share priced at $500 plus. And Musk reportedly pushed to allocate up to 30% of shares to retail investors. That's 3 times the typical allocation in a major IPO, which usually reserves the vast majority of shares for institutional investors and only gives regular people 5 to 10%. Musk wanted his fans, his Twitter following, his Tesla owners, his actual retail audience, to be able to buy in directly. Which is also a pretty effective way to build a shareholder base that is emotionally invested in defending the stock price rather than coldly analyzing the fundamentals. A retail investor who bought in because they believe in Mars and Starship and the mission is a very different kind of shareholder than a pension fund analyst running a discounted cash flow model. The retail shareholder is less likely to sell on a bad earnings call. They're more likely to see critical coverage of the stock as an attack on Musk personally rather than legitimate financial analysis. That's an extremely useful base to have underneath your stock price during the exact period when the AI segment's losses are going to start showing up clearly in quarterly filings. On debut day, the stock opened at $135 and by the next full day of trading it had jumped 20%, with roughly 244 million shares changing hands. Trading volume the day before had topped 500 million shares, which is in the same range as Facebook's IPO back in 2012, one of the most heavily traded debuts in history. But not everyone is convinced the valuation makes sense. CFRA initiated coverage with a sell rating and a price target of $115, nearly 29% below where the stock closed that first week. Morningstar's analyst valued the company at $63 a share, a fraction of where it actually opened. Their argument is straightforward. SpaceX's capital expenditures in the first quarter of 2026 alone hit $10.1 billion, more than double the same period the year before, and the majority of that spending went toward AI infrastructure, not rockets or satellites. The company is burning enormous amounts of cash to build out a vision, orbital data centers, satellite megaconstellations for compute, that has not been proven to work at any meaningful scale yet. One analyst framed it as needing a 20 to 25-year time horizon to actually justify the valuation, which is an extraordinarily long time for public market investors to be asked to wait. So here's the actual structure of what happened. A profitable rocket and satellite company merged with a money-losing AI company 4 months before going public. The merger let the combined entity walk into the largest IPO in history with a story about Mars colonies and orbital data centers and vertical integration, instead of two separate, much harder conversations. Can xAI ever catch up to OpenAI and Anthropic, and is SpaceX's valuation actually justified by satellite internet revenue alone? The compute leasing deals to Anthropic and Google solved an immediate balance sheet problem and generated headline-friendly revenue numbers right when investors were reading the prospectus most closely. And the IPO structure itself, the stock split, the oversized retail allocation, was built to maximize enthusiasm and minimize the kind of cold institutional scrutiny that might have asked harder questions about the AI segment's actual path to profitability. None of this means SpaceX is a fraud. The rockets are real. The satellites are real. 10 million people are paying for Starlink right now, today, for an actual service that actually works. But the $2 trillion number on the day of the IPO wasn't really a valuation of rockets and satellites. It was a valuation of a story, told at exactly the moment the story was hardest to fact-check, using exactly the financial structure that made the weakest part of it the hardest to see. Whether that story holds up over the next 5 years is a different question entirely. Rise and ruin will be watching the next earnings call.